Do you know that debt mutual funds are a good alternative to fixed deposits? Our industry expert, Mr. Hariharan, will prove this through an analysis. Hari, over to you.
I'm sure many of you would also be tracking what is happening to the interest rate in the country. And RBI sort of sets the interest rate depending on various factors. RBI has two roles which are very important. One is to control inflation. On the other hand, it also is supposed to ensure that there is economic growth in terms of good GDP growth. So it's a balancing act. Sometimes when you try to control inflation, you also have to compromise or cut down on economic growth, and vice versa. When you want to push economic growth, you may end up actually stimulating inflation. So it's a balancing act. It's a tight rope that RBI tries to walk. And if you recollect, if I were to take you back to 2020, March is where we started COVID and the impact of COVID, and the economic activity sort of came to a standstill. Every central government of countries, the central bank of every country, every government of country did their best to ensure that somehow the economic activity starts. Because if you recollect, all of us were sitting at home. There was no manufacturing, there was no production that was happening. Nothing was working, right? An economy can't grow without activities. So to spur and give a kick to the activity, all the central banks reduce the interest rates. So the interest rate that the RBI looks at is called the policy rate, which is actually called the repo rate. Okay, I'm sure many of you track this. Repo rate in 2021 September. So they brought it back down to 4% in March 2020, so that loans become cheaper, and you and I will try and do some purchase, okay, just because the interest rates are lower. Over the last 1 year or so, you will find that all central banks across the globe have started increasing the interest rates. RBI has also done it. In fact, if you look at the rate as on 5th of July, even today we are at 6.5% repo rate. But just to give you some comparison, we have taken the rate as on 5th of July 2023. You will see that RBI has increased the repo rate by 2.5%. Let's look at what has happened to the instrument. So ideally, if RBI has increased the rates, you should see an increase in rates across all the debt securities instruments, right? Let's look at this. So if you look at a 6-month CP is a commercial paper, and commercial papers are issued by companies. And there are conditions for the company to issue a commercial paper. Not every company can issue a CP. So there are standards to be maintained before the company can raise money by issuing CPs. So the CP rate was 4.1%. That went up to 7.4%. RBI increased the rate by 2.5%. But CP rates have gone up by 3.3%. Similarly, a 1-year AAA rated bond, corporate bond, AAA is a rating that is given by credit rating agencies. Just like, for example, you do a Shriram Transport FD or the Mahindra Finance FD, you would see that they have got ratings F AAA, M AAA kind of. So those are AAA rated, and AAA is considered to be the safest and with very low risk of default. So our 1-year AAA bond in 2021 was giving 4.2% because interest rates were slashed down. It has also gone up to 7.5%. Again, there's a 3.3% increment in the rates there. So similarly, 2-year and 3-year also, you will see that the interest rates have been in line and even better than what RBI has actually done, right? Let's look at FD. FD was 5.4%, and this FD is SBI fixed deposit data. 5.4%, September 21. RBI increased rates by 2.5%. FD rate has gone up to only 7%, increment of only 1.6%. Okay, now understand this very carefully. Many of you would also have taken loan in the past. Some of you might be having loans today also. Please understand this carefully. If anybody has a floating rate loan in the chat, in the group, okay. So if you've got a floating rate, if you would understand this and appreciate this, that the moment RBI started increasing the rates, your finance company or the bank would have sent you a welcome letter, saying that we are very happy to announce an increase in your interest rate and therefore an increase in your EMI or an increase in the tenor. Yes or no? Did you all get some letter? Yes. So what happens, understand. So banks are very smart people. When RBI increases rates, they are very quick to increase the loan rates also. They don't wait. They just wait for the announcement by the RBI governor and they're ready with the draft. They just have to change and type and send it to all of us. But when you do a fixed deposit, though RBI has increased the rates, they are slow in increasing the rates. Why? Because the rate that you pay on the deposit is a cost to them, while the rate that they charge to you on a loan is an income for them, right? The difference is what is their net income. So when they increase the rate for deposits, okay, the margins comes under pressure, profits are under pressure. So that is how they are smart. So when it comes to increasing loan rates, they are fast. But when it comes to increasing deposit rates, you will find there's a lag between what RBI has done versus what the bank has done. In fact, I'm told by somebody that after this increment, there are certain banks have actually cut down the rates also after increasing it. I don't know how true it is, but some banks have done it, it seems, by 25 bips or something. Now imagine this reverse situation, because interest rates are never going to always go up. They will also at some point in time start coming down. So it also runs in cycles. You will have 2-3 years of rate increases followed by falls, followed by increase, and so on and so forth. Now imagine the reverse situation. If tomorrow RBI cuts the interest rates from 6.5%, let's assume they make it to 5.5%. What will the banks do? They will quickly reduce the deposit rates, but they will slowly reduce your EMIs. Getting it? So they are always smart. So this is how it works. So what I'm trying to communicate by this data point is that while the economy has seen an increase in interest rate, RBI has increased interest rate by 2.5%, the transmission of these higher rates has happened much better and faster in capital market securities, which is where your debt mutual funds participate, versus a fixed deposit. Even if you look at small saving schemes, look at the rate at which they have increased. Hardly any increase. PPF is now 7.1 only, isn't it? So look at what is happening. So that is why, though FD is maybe a good option, PPF is a good option, can you look at alternatives, as I'm trying to communicate? Okay, so there are better options available.
Thanks for your detailed explanation. Are you in search of a personal guide who can remove the stress of handling your finances? Then please feel free to avail our expert consultation. And also you can attend our webinars to gain investment related insights. Both the consultation and webinar are absolutely free, and you can find the link in the below description. Please like and share, and do subscribe to Holistic Investment.